Welcome, everyone, and thank you for joining us today. For anyone who doesn't know me, I'm Doug Elliott here at Brookings in the Economic Studies program. I'll be running today's event along with Martin Bailey, who you'll see shortly. He was my colleague from Economic Studies. He'll be moderating two of the three panels, and I'll moderate the other panel. Both of our bios are in your packets if you're curious about us. In a moment, I will walk you through some slides to explain what capital markets are, why we care about them, and some important information about their size and composition. The rest of the morning then will be devoted to hearing from people who represent the key players in the capital markets. And I'd say the three most important groups are those who use the money supplied by the capital markets, those who supply that money, and the regulators who watch out for the public interest. So after my opening remarks, I'll turn the stage over to Martin, and he'll moderate the first panel. Today's event constitutes the launch of a series of events and papers in which Martin and I and colleagues of ours will be focusing on important aspects of the capital markets and how they're regulated. So we thought it would be useful to start out with an overview of those markets before continuing with those events. Our view is that relatively little attention has been paid to capital markets compared to the banking industry, which in a sense is odd because capital markets actually supply considerably more funds to U.S. companies and households than banks do. So today's event is part of our attempt to rebalance the discussions in Washington and around the world. So for those of you who aren't already immensely familiar with it, I'm going to go through the basics, and I will do it fairly quickly. I was looking for a good definition of the capital markets, but there actually isn't an immensely good one. It seems to boil down to it's the market for securities that are issued by people who need the money and bought by people who want to invest their money. And the main types of securities are stocks and bonds. I'll get more into all those aspects there. So the so-called primary market is where the people who need the money issue directly to the people who have the money, the investor community. The secondary market is then where investors trade among themselves those securities for as long as the securities continue to exist. Some securities like bonds have fixed maturities and therefore go away at a certain point. So, sorry, I should have let you briefly see that one. So why do we care about them? Well, markets actually provide most of the external funds that companies in the U.S. use to grow. To give you a comparison, there's about $8 trillion of corporate debt outstanding in the U.S. At the most, bank loans to corporations are a bit under $3 trillion. So you're talking about 8 versus 3, and 3 may even exaggerate a little bit. Capital markets also are important funders indirectly of most mortgages. Markets also fund our national and state and local governments. In fact, there is $18 trillion of debt outstanding from the national government and state and local. They also provide an opportunity for investors to put their money someplace useful. So households in particular need to save for college or retirement or other needs, and these markets provide a $38 trillion opportunity to invest money in the U.S. The markets also give the U.S. a diversification of funding sources that is not available to nearly the same extent in most of the rest of the world. Europe and most of the world is bank-dominated. So that's one reason they've had more troubles after the financial crisis. We've benefited from having markets as well as banks as potential sources of funds. And for that reason, as many of you are aware, the European Union and other economies like China are looking to build up their capital markets. In the case of the EU, a fairly explicit attempt to emulate the U.S. approach, though not obviously in every detail. Markets are also a more efficient intermediary for many types of funding needs than banks are. So more straightforward things like lending money to a well-known, large, credit-worthy corporation, it's just more efficient to do that in markets. And of course, as we've seen, markets impact financial stability in many different ways. So that's why we should care. Who are the main issuers? And there'd be some others I don't have listed here, but there's corporations are important users of the capital markets. Financial institutions, which are also corporations, but it's useful to, because of their separate role, to look at them separately. Our national government and national governments around the world, and subnational governments, regional and local governments, are important borrowers. And then we have packagers of securities, of securitizations. So people who pull together packages of home loans, for example, and then issue them out to the market. And what is it that issuers want? Well, I'm going to go over this briefly because we have a whole panel in which some issuers and those who work closely with them are going to talk to you about what issuers want. But so you have a little preview here. My own short list is first, they're looking for the ability to issue a range of instruments that meet their particular needs. They don't want to be limited to a couple instruments that don't cover what they want. They want to sell to a wide range of borrowers so they can get the best possible deal. They want their issues to be priced fairly, or honestly, they probably want them to be priced unfairly in their favor, but that just doesn't work in the long run, so they'll settle for fairly. They'd like low transaction costs. They want the simplest and fastest reasonable ways of doing issuances. And they want a good secondary market because it's rare that an issuer only issues once. So they want whoever buys into their first issuance to have a good experience. And part of that is the liquidity of the secondary markets. Okay, so what are the types of securities? The two broad categories that are most important is there's equity, what we call stock, and that represents an ownership stake in a company or sometimes in a set of projects or a pool of home loans or something. So you share proportionately in the gains and losses of that entity. A still larger category are bonds or fixed income instruments. So these are IOUs that promise a fixed set of payments in the future. Corporate bonds are a key part of that. There's commercial paper, which is really a corporate bond that's of quite short maturity. Preferred stock is a form of equity that has the economic characteristics of a bond in that you get fixed payments. There's some minor differences between all these things, or these wouldn't exist as separate instruments, but I won't go into all that. And of course, there are government bonds, including what we call municipals, even though they're not all issued by municipalities. So anything that's at the state or local government level in the U.S., we call a municipal bond. There are also convertible bonds and preferred stocks, which are essentially bonds or preferred stock where you receive a fixed payment, but you also share in the upside in that you as the investor have the ability at your choice to convert it into stock under certain terms. And then there are securitizations, which are packaging of large groups of loans. So who are the investors? The main categories I've got listed here. There's individual investors, there's mutual funds or so-called registered investment companies. There are other types of managed funds like hedge funds or separate accounts that aren't mutual funds. There are financial institutions. Banks and insurers in particular are big securities buyers. Pension funds. Governments actually buy securities. Central banks, as you may have noticed lately, are buying a lot of securities. And corporations often need to own some securities, particularly money market type securities. So what is it investors want? Again, they look for a wide range of instruments that are suited to what they want in terms of maturity and the type of risk that they're looking for. They want to avoid unnecessary complexity. They may live with complexity, but they don't want it if it's unnecessary, and it's a negative even when it is necessary. They want transparency from the issuers so that they know what's going on. They obviously want to avoid being defrauded or misinformed. They too want low transaction costs for buying and selling of securities. And the larger players want the ability to buy and sell quite large amounts without moving the markets too much. And then you'll notice on the last bullet point, I use careful wording to say appropriate transparency of market transactions. This turns out to be a much trickier issue than you might think. In general, we always like transparency, but if you're a large buyer or seller and you can't get it all done in the first minute, you don't particularly want to have to tell everyone, I'm buying a lot more, so feel free to push the price up. So you end up with a number of issues about how you have a level of transparency appropriate for the market while still allowing large transactions. So how big are the U.S. markets? And to put it in technical terms, it's really, really big. Outstanding issuance, so the outstanding issues out there right now is something like $38 trillion in the U.S. Now, a significant amount of that, as you'll see on this chart, is U.S. Treasury bonds. Our government turns out to need a lot of money. But if you can see, what shade is that? Oh, it's a nice sort of aqua shade, the corporate debt part in about the middle. That's $7.8 trillion. We're talking about a lot of money. And if you compare that to bank loans to corporates, there's only $1.7 trillion of commercial and industrial loans. And then commercial real estate, which would also be equivalent to some of the mortgage things that are shown here. So it's not a pure comparison, but there's another 1.1 trillion of that. So you have less than $3 trillion compared to at least $8 trillion. So corporates are big borrowers from the markets. And in issuance terms, you have, what is that, about $6 trillion in 2014 of issuance, of which about a corporate portion is about $1.5 trillion. Now, how does that compare to foreign markets? I'm going to show you fixed income here, so corporate debt securities, and then I'm going to show you corporate equity securities, so stock. The overriding point here to realize is that the U.S. has the largest and most advanced capital markets, both in terms of equities and in terms of debt. And so if you look at, I deliberately put the non-financial part on the bottom even though it's smaller, because from a policy point of view, we tend to care more about the so-called real economy, the non-financial institutions, than we do about the financial institutions. So you can see that U.S. has corporate debt outstanding that's in the range of 30% of the size of our economy in terms of gross domestic product. That's a bit higher than the United Kingdom, substantially higher than Japan, and way higher than Germany. And Germany's relatively typical for Middle Europe, though it's on the low side probably. And China, of course, is also pretty low at this point. So there are reasons why many of these economies are trying to move in our direction on these things. I also showed the financial institution borrowing here because you can see that markets are also an important way in which we get money to banks and insurance companies and other financial institutions who then put the money into the economy. And taking all that together, we in the United Kingdom are way up there compared with the rest of the world. And finally, one of the main ways of measuring how big stock markets are is to look at what's the total value of all the companies out there that are listed on these stock exchanges, so-called market capitalization. And you see the U.S. is at 140% of our gross domestic product. UK is not wildly behind, and then most of the rest of the world is significantly lower than that. Now, this depends partly on whether you're in a boom or not. If you're in a bubble, it artificially inflates the apparent size of of your stock market. But I think this is a relatively fair measure of the key point, which is simply the stock market here is substantially larger and also substantially more active than in the rest of the world. So with all that, let me turn it over to Martin Bailey to introduce the first panel. Thank you.